Welcome to This Explainer. Today, we're diving into the foundations of accounting and small business finance. But don't worry, we're not going to be staring at dry, boring spreadsheets. Instead, we're going to learn the ropes through a story. We'll follow the journey of two ambitious bakers to see exactly how money actually flows in a real-world business. Let's get right into it.
I mean, what if you could turn something you absolutely love into a real thriving business? It's the ultimate dream, right? We'll meet Amelia and Julia. These two are recent grads and they share two massive passions in life, baking incredible treats and caring for animals. So they have this recurring dream of building a bakery that doesn't just sell amazing cookies, but actually gives back to local animal shelters. They aren't looking for just a hobby. They want a real, self-sustaining business.
But, instead of just rushing out and signing some massive, expensive commercial lease right off the bat, Amelia and Julia are smart. They decide to learn the ropes at a local bakery first. They really want to understand the business from the inside out. So during their shifts, they're watching everything. They observe how raw dough transforms into a finished product, how customers flow through the storefront, and, crucially, how money actually moves in and out of the register. They're gaining that vital, hands-on knowledge before taking the leap to build their own dream.
Okay, let's dive into this. Every business has to start with some sort of resources, right? Amelia and Julia decide it's finally time. They each pull out $50 of their own hard-earned cash to launch this bakery. Amelia chips in $50, Julia chips in $50, so that gives them exactly $100 in initial cash to start building their empire.
Now, behind the scenes, this introduces a massive concept: equity. Equity is simply what the owners put into the business. So their business now has $100 in cash. That cash is what we call an asset. And this sets up the absolute golden rule of accounting. Assets equal liabilities plus equity. Right now, they literally owe nothing to anybody, so their $100 asset perfectly matches their $100 equity. Make sense?
Well, they quickly hit their first operational hurdle. They need an oven to actually bake these treats. They find a fantastic small used oven online, but there's a catch. It costs $180. They only have $100, so they're $80 short. Enter Amelia's aunt. She completely believes in their vision and agrees to loan the business exactly $100. Boom. This instantly brings their total cash on hand up to $200.
And this brilliantly illustrates how that fundamental accounting equation handles new money. Look at how it balances. Our total assets, which is now $200 in cold, hard cash, perfectly balance against our liabilities and equity. That right side of the equation just breaks down into the $100 loan from the aunt plus the original $100 in owner equity. The business stays beautifully, perfectly balanced.
Now that loan from the aunt introduces another really key concept, a liability. A liability is simply an obligation or a debt that must be repaid. It is absolutely not income. Even though their cash balance just doubled, that extra $100 isn't theirs to keep. Someday, they got to pay it back. This is absolutely crucial to understand because accounting systems like QuickBooks track liabilities entirely separately from your hard-earned revenue.
Let's move along and see how this builds. Amelia and Julia take their $200 in cash and go buy that used oven for $180. This right here perfectly highlights the difference between an asset and an expense. When they buy the oven, their wealth doesn't just disappear into thin air. It simply changes form. It goes from cash into a long-term piece of equipment. Their total assets remain exactly the same. However, spending money on things that get used up immediately, well, that's a totally different story.
Because to actually get to baking, they need the essentials, right? They spend money on small daily costs: flour, sugar, and some basic packaging. All of this totals up to exactly $20. So they spend the remaining $20 in cash on these items. And just like that, their actual cash balance in the business drops straight down to zero.
The absolutely crucial point here is truly understanding what an expense actually is. Unlike that oven, which is going to sit in their kitchen baking cookies for years, these ingredients are used up immediately by the end of the day. They're consumed to generate today's products. That is what makes them expenses. And here's the kicker. Expenses reduce your profit, and because they reduce profit, they eventually reduce the owner's equity. In an accounting system, these costs flow straight into your profit and loss statement, which is completely different from how that long-term oven is treated.
Thankfully, that zero cash balance doesn't last very long at all. Their very first weekend arrives. Amelia and Julia take their freshly baked treats to a small, local market. And guess what? People love the cookies, they absolutely love the mission to help animals, and they completely sell out. They bring in exactly $160. This is huge. This is it, their first official revenue.
Now, what's really interesting about this next part is how we update our business picture to reflect this big win. On the asset side, our cash is back up to $160, plus we still own that $180 oven. That brings total assets to $340. Liabilities remain at the $100 loan from the aunt. But look at equity. Equity has grown to $240 because it now includes their profit. Through spending, borrowing, and earning, the entire system stays perfectly balanced. It's like a giant puzzle where all the pieces fit.
So, the crucial point we need to dig into here is the difference between profit and loss and cash flow. Let's do some quick math on their business performance. They had $160 in revenue, minus $20 in ingredient expenses, giving them a pure profit of $140. But wait a second. Their cash balance is actually $160 sitting in the bank. Why? Because profit and cash flow are deeply related, but they are not the same thing. Profit measures how well the business is actually performing. Cash flow? That just measures the literal movement of dollars in and out of the bank account.
So why don't the two numbers match up perfectly? Well, because cash is affected by so many things other than just day-to-day profit. I mean, it went up because of that loan from the aunt and the owner investments from Amelia and Julia's initial $50 each. It went down because of spending on long-term assets like the oven, and of course it was affected by revenue coming in. This is exactly why a program like QuickBooks tracks your profit and loss completely separately from your statement of cash flows. You literally need both to see the real truth of what's happening in your business.
Amelia and Julia have built an absolutely perfectly balanced foundation. They've totally mastered the basic rules. But here is the big question. How are they going to scale this exact system as they grow? I mean, think about it. As they start tracking massive amounts of inventory, introducing complex cost of goods sold, and managing repeat wholesale orders, the truth is, whether you are managing $100 at a farmer's market or scaling a multi-million-dollar enterprise, it all runs on the exact same elegant structure we just went through today. So keep exploring and keep building.